So let's talk positioning. So 22, tough year for obvious reasons. 23, good year for, in some respects, obvious reasons. But, you know, the willingness at the beginning of the year to sort of try and go where the puck was going in your mind and get big again in tech. Now's the hard part, okay?
Yes.
These stocks have gone up a lot, 40, 50%, in some cases like NVIDIA and Meta, more than 150%. Interest rates are elevated again. NASDAQ's been depressed lately. Where the risks lie now, and how are you thinking about your own positioning relative to that?
Right. Well, I mean, you and I were just talking backstage. I mean, I think about the last 3 years. You know, I feel like I've been through a lot of trauma, starting with the March 26, 2020 episode on Halftime Report. That was the day the market bottomed in 2020. And it was very stressful. And I said, you know, Congress has gone all in, the Fed's gone all in, we've gone all in. We don't know if it's going to be 3 weeks, 3 months, or 3 years, but we'll get to the other side of COVID. But little did we know that the Fed was going to do something, you know, historic, 0% interest rates, which would cause long-duration growth assets to explode higher. Little did we know that the Fed was going to make a pretty grave miscalculation, right? I mean, Neel Kashkari, who was just on the program or just on CNBC yesterday or the day before, right? Headlines all over the place. Go back and go ask your OpenAI about this, but there are headlines everywhere. June of 2021, when the world knew inflation was here. I mean, the cost of a cargo container had gone up by 10x, okay? He says we're not going to have rate hikes until 2024. That's how wrong the Fed's forecast was in June of 2021, because they were making the argument that inflation was transient. Go back and look at their forecast. So here we are. We've had the most parabolic rate rise in history, right? Obviously caused the convulsions and the trillions in losses that we had in 2022. Putting the economy through that is not a good thing, right? But now they have to slow the economy in order to try to get inflation under control. So I think the risk has increased that the Fed has overshot. We see lots of data points of consumer slowing, whether we're looking at travel demand or we're looking at leisure demand for things like RVs or housing demand. I mean, think about this. We've gone from effectively a 0% interest rate environment in ZIRP, where corporations borrowed for free and consumers borrowed for free, to now we have 8% mortgages, we have 10% car loans, we have 20% credit cards, student loans are about to kick in, the huge bulge of corporate borrowing that occurred at next to nothing April to December 2020 now has to get refied at rates a lot of these companies can't afford. So this is the definition of lag effect and headwinds. And I'm not certain whether we're going to have a hard landing or a soft landing, but I am certain that the probability that we're going to have meaningful slowing in 2024 has gone up.
So have you taken your positioning down?
We've reduced our exposure quite considerably, by at least 50% since the start of the year. So dollars at risk on the long side relative to dollars at risk on the short side are down by at least 50%.
Do you think the Fed's done raising rates or not? I mean, you already said you think they might have overshot, done too much in too short of a period of time. Are they done?
You know, there's a reason we have sayings like the Fed's caused 10 of the last 7 recessions, or that they operate, they drive the car looking in the rearview mirror. What I'm concerned about, I just listen to their words. Like you. And if you just listen to their words, you have to be pretty fearful there's going to be another rate hike. Now, what is the market pricing in? As of this morning, the market was pricing in a 26% chance of another rate hike. So the market's basically saying 75% chance we're not going to see a rate hike before the end of the year. So the market's still calling a bit of the bluff of the Fed, but I think there's a good shot you have one more rate hike because I think they're really committed. He wants to be Volcker. He doesn't want to be remembered as the Fed chair that didn't slay inflation. He doesn't want to see it tick back up. But he also acknowledges that the envelope as the pilot of the economy to stick that landing is very, very narrow, right? And so what it probably means is that we're going to have more slowing in 2024 than they want. But the reason the market is pricing in 2 or 3 rate cuts next year is because the market is saying the economy is going to be worse than you're currently forecasting. Think about this. The Fed forecast in June of this year for GDP growth for 2024 was 1.1%. Today, the Fed forecast for GDP growth in 2024 is 1.5%. It went up. But those of us living in the real economy, seeing these interest rates, et cetera, trying to buy a car or a house or an RV, like, it just, that doesn't add up to me. Something doesn't add up.
They've gotten their economic projections wrong and their inflation projections wrong, which is a potential issue.